know the destination, but do you know the path to take you there? This is Profits to Wealth, a show about investing and financial planning hosted by the founders of Lake Hills Wealth Management. We'll cover commonly asked questions and dive into important financial topics such as taxes, Social Security, and how to retire on your terms. It's time to talk money, planning, and freedom. Here's Jack and Jason.
Welcome to another episode of Profits to Wealth. I'm Jack Marino Jr., and I'm here with my co-host, Jason Clevlen. We're the founders of Lake Hills Wealth Management, and our mission is to help you achieve and maintain financial freedom. So we've found that there are two things that you need and that are critically important to achieving financial freedom. Number one, an efficient financial plan, and number two, a nimble investment strategy. So if you're retired or within 10 years of retirement, having these two ingredients puts you at a major advantage.
So you're probably wondering, what does that mean? An efficient financial plan means you know exactly how your retirement income will be funded while offering flexibility to handle change. It outlines the steps needed to be tax efficient and provides structure for your assets to minimize the chance of being forced to sell investments at a loss. It also means you have a contingency plan for the unexpected. A nimble investment strategy is one that focuses on protecting your investments from significant loss. While investing for growth is important, your portfolio needs to be flexible. In other words, there are times when it makes sense to invest for growth, and there are times when it's important to shift and be more defensive to protect your principal. So, Jack, what's going on in the stock market? Why has it rallied? What could go wrong? And what do we do to continue navigating these unprecedented times?
That is a very good question. And so, let's just do a little recap. As of now, the economic data appears to have bottomed. The April data is most likely the worst, we hope. And the markets have sharply, rallied sharply off that March 23rd low because, again, the markets are usually ahead of the economic data by around 4 months or so, right? On average in a recessionary period. So that the markets are always looking forward. We have to always remember that.
Right. It seems logical that should be the low of economic data because the economy was essentially shut down, turned off. Not very much was happening. And so as things reopen, the activity starts to tick upward.
Right. But however, there's still a number of risks that do exist to the economy and thus the financial markets. Especially at this point where the markets are today, we base our portfolio's risk off of indicators. It does feel like there is a whole lot more risk than there is reward, but the market can prove you wrong for a long time. So that's why we are indicator based in our investment management. So let's talk about why has the market rallied? Well, number one, we've flattened the COVID-19 case count curve. So flatten the curve. And during that time of the lockdown, the healthcare system did not get overwhelmed. For the most part, maybe New York, you could argue, it got overwhelmed. But in the whole, from the U.S. standpoint, did not get overwhelmed. The Fed quickly provided a whole lot of support, liquidity, to the tune of about $3 million.
That would be $1 trillion.
What did I say?
You said million.
Million. I'm sorry. We need to add a couple more zeros to that. $3 trillion, thank you for correcting me, of liquidity. Now, that's a lot of money. We're a $20 trillion economy. And they did that in the amount of time, let's say, what was it, maybe weeks, maybe a month. We did that.
Yeah, about 5 weeks.
5 weeks versus when you think about 2008, it was a lot of finger pointing and, wanting to make sure that we let the companies that did wrong fail. And it took years to be able to pass that kind of stimulus. Well, this took, let's just call it weeks, $3 trillion over weeks. That's a lot of liquidity. Okay, so last time we had this kind of liquidity was, again, 2008, 2009 financial crisis, which, again, took years to do. Let's see, what else? Congress passed the CARES Act, roughly around $3 trillion in an additional relief to get everybody through this terrible time. And then we also have, the reopening phase, which is where we're at now. So the economy is starting to reopen a whole lot quicker than I think most initially thought, without, and then plus we haven't seen significant increase in the COVID-19 cases as a result of the reopening either as of yet. And then the last two things is, we continue to see medical progress, meaning, there's a lot of hours and money being thrown at a treatment and vaccine. And we've seen some progress there. So we've got a lot of people and a lot of money at work at those two things, which is, I think, critical going forward. And the last thing is, continued progress on, let's just say, all of these. Combination of all of these has really led to where we're at today, which is, nearly 3,100 in the S&P 500, which I think has surprised everyone.
Yeah, and that's really the bull case right there. And as long as we continue to see progress on those fronts, the market can certainly go higher. At these levels, investors are pricing in, a quick return to economic normalcy. If you watch the news or CNBC, you often hear them talking about earnings for 2021. A lot of investors are just completely looking past 2020 and what's going on right now. So that's why there's a big disconnect in what's happening today and what the stock market has been doing.
Well, let me ask you this. What could go wrong?
Yeah. So the bear, there's always a chance, things don't go perfectly and the bear rears its ugly head again. So some things that could cause this market to falter would be a resurgence of infections, the so-called second wave. And if you see that happen and, pockets of outbreak where cities potentially have to shut down, that creates an economic slowdown. That would be a negative for stocks and for the stock market. Also, we don't really know what the impact on consumers is yet. We're just starting to see the economy reopen and there's maybe some pent-up demand, but have consumer habits changed? This will take a little time for this to all be sorted out, but are consumers going to tighten the belt or are they going to return to their previous spending levels? If consumers tighten the belt and they don't resume spending, well, that's not going to be good for corporate profits. We also have huge unemployment levels we haven't seen since the Great Depression. And if these lost jobs don't start coming back, well, that's going to be a negative for the economy. That creates a slower environment, less spending. The economy reopening is very important. In order for the stock market and the financial markets to continue rallying, you really need the economy to continue reopening, and we need to get back to full capacity or near full capacity by the end of the year. Because as I mentioned, a lot of investors are pricing in a large return of economic activity by 2021.
A V-shaped recovery.
Yeah, the so-called V-shape. So hopefully that does happen. Nobody knows for certain. So you have to monitor these things and monitor the markets and see what is the data telling us. Another one that's reared its head here recently again is tension between the U.S. and China. We've seen some tensions begin to re-escalate, potential trade war re-escalation. This was a big headwind over the last couple years. Every time you saw tariffs increasing and tensions escalating, that was a big headwind for the stock market. And so we're, starting to see these tensions escalate. We don't know how bad that's going to get or if it's going to get any worse than it is right now, but that's definitely a potential headwind for the markets that aren't being factored in, I don't think.
Right. Yeah. The V-shaped recovery implies that earnings for the S&P 500 returns to at least the 2019 levels of around 165. Who knows? The point of all this is we've kind of done a little replay on what, the bull case, what could go wrong. So the bear case, nobody knows what's going to happen. As Howard Marks would say, the future is a distribution of possibilities. You may know some of those possibilities, but you don't know which one's going to play out and how it's going to play out. So what can you do? Well, we have a different approach. I know you touched base on nimble investment strategy. Well, here's how we navigate, our portfolios through all this. We got to be nimble. What does that mean? That means we adjust risk when our indicators favor, let's say, safety, or if they're favoring growth, then we're going to add risk when it favors growth. When it favors safety, we're going to reduce risk. And the biggest risk to most investors is going to be stock or equity risk. Now this, these indicators have helped us because we were flashing some warnings, favoring safety in February, March, and that basically helped us move to safety, as I mentioned, which thus helped the portfolios outperform this year. And more importantly, gave the client, a smoother ride because we were reducing volatility or losses in the portfolio. And then also, the other benefit of that is it gives you some dry powder to be able to position when the markets kind of have exhausted the selling and the bottom is in. We have no idea if the bottom is in, but, we obviously did some buying. So that is one of the things, and I think that's the key thing that makes us different in that when we say nimble is that it's not rigid in, let's say, for example, this client's going to have 30% in stocks forever and 70% in bonds. Nope, maybe they have 0 in stocks throughout a period of time. Maybe it doesn't make sense to own stocks. Maybe it makes sense to be cautious. So we have lots of technical or indicators, let's say circuit breakers, whatever you want to call them, that determine if we're going to take on more risk or if we're going to seek safety. And then so when risk rise, then we're going to reduce the stock exposure in the portfolio, or we're going to hedge that risk by, adding, let's say, short positions, long treasuries, or maybe we just have a lot of cash. And then by reducing losses and volatility, if you're retired, that's going to be very, very important to do. Reducing losses and volatility in a time when you don't have a whole lot of capacity to make up for those losses. So, if you're younger, time is on your side. If you go through a period of, let's say, a recession and a big loss in your portfolio, you do have time to earn additional income and time to wait for the markets to hopefully come back. But let's do, some simple math here, understand the math of losses. So let's say if you had a 35% loss in your portfolio, how much gain would you have to get back to even?
Yeah, if you lose 35%, you don't just make 35% and you're back to even. That's not the way the math works. You actually have to make a gain of 54% just to get back to break even. So think about it. You have $1. Mm-hmm. You lose 35%, so you've lost 35 cents. You're down to 65 cents. 35 cents is more than half of 65 cents. So you've got to make more than a 50% gain just to get back to break even. And so that's why we say it's critically important to have a nimble investment strategy, especially if you are retired or within 10 years of retirement, because, like you just said, Jack, if you don't have the time to recover the losses, then you don't want to sustain those losses in the first place. And I've seen it before where, you hear people say, oh, just hang on, it'll come back. But reality is if you're retired or near retirement and you don't have time on your side, you just might not be able to withstand that loss because you may get to a certain point where you're putting your ability to retire or stay retired at risk. Mm-hmm. So if you have a strategy that can help minimize the risk of loss or reduce your volatility, well, then that puts you in a much better situation to ride through these uncertain times. And so, being nimble with portfolio, adjusting risk, as you said, or in other words, at times reducing the amount of stock exposure that you have can be very helpful in, people, not only having a higher comfort level with their portfolios, but also it improves their ability to retire, stay retired if they're not sustaining large losses.
Right. And this story may sound familiar. What usually happens, let's say the buy and hold type strategy, is when you have times like this where you have massive losses in a very short period of time, or just any recession or drawdown in the portfolio, what typically happens? The client or owner of that portfolio sell. You said, you know what, I can't stand it anymore. I'm losing money every day. I'm going to sell. And I'll get back in when? Well, maybe at a later date when things are more certain, right? Well, what happens? So they sell near or at the bottom, and then they wait till everything recovers. And now how long does it take them to trust the markets again and recover the 35% losses that they incurred? So that 54% gain may take years and years and years, especially if they become more conservative of an investor when they get back in, which has happened time and time again.
Yeah, happened to a lot of people post, the tech bubble.
08.
A lot of people got hurt again in 08 and 09, and you see this just repeated cycle. And so, that's why we invest the way we do with our nimble strategy of adjusting risk. And, like everybody else, Jack, we have our own ideas and thoughts on, what might happen with the economy and what route things may go. However, nobody knows the future. Nobody knows what's going to happen. So one of the things that we rely on is the data. What is the data actually saying is happening with the economy? What is the data saying is happening in the market? What is the momentum showing? Where are the assets flowing? I mean, there's a number of different indicators that we use that signal when changes are occurring in the marketplace. And there's no one indicator that's perfect, but that's why we look at a basket of indicators. And
sure. And most of them are based on direction of the internals or direction of the market, because the economy can be flashing warning for a long time, fundamentals, meaning like, oh, things are expensive. How many times over the last 10 years has someone said the market's expensive, but the market totally ignored it for years and years and years and years? And that can happen. So that's why we built our strategy based on, like you said, a basket of indicators. You're going to ride the market until the tide turns. And when that tide turns, we're going to seek safety. And when that cycle runs out and it's time to take on additional risk again, we're going to get back in. And that strategy has worked very well. And, we keep adapting over time because nothing can stay the same. But I think our clients are extremely happy this year. And some of them are actually positive, for the year, which is remarkable. So we're outperforming the markets. We're in a comfortable spot right now. No one knows, like you said, what's going to happen next. But we watch like a hawk these indicators, and when that flashes again, safety, we're going to protect our clients. So if you are wondering, do I have the right strategy? Am I taking on too much risk? And I would say at this point in time, with the markets near 3,100, it is a great time to evaluate your portfolio. You may have a whole lot more risk than you thought you did here. And if we have a second wave, or if we get in another trade war, we're in an election year. There's a lot of things that can happen, curveballs here. Now's the time. Give us a call. We will actually put together a comprehensive analysis for you, showing you your portfolio, what we would recommend and why. We'll also do, complete a financial plan for you. So we're going to take care of the two ingredients that make up a successful retirement or equal financial freedom on your terms. So that's that comprehensive, efficient financial plan and a nimble investment strategy. So give us a call or visit our website, www.lakehillswm.com, or feel free to, email us, jack@lakehillswm.com or jason@lakehillswm.com. There's no obligation. If you decide this isn't a fit for you, we can move on and part as friends. No hard feelings.
Absolutely. Hey, Jack, on that note about an efficient retirement plan or an efficient financial plan, one thing I want to touch on is an important part of that is being tax efficient. And one of the things that we do, and we have focused a lot on lately, is a strategy called tax bracket maximization. And, this is important because if you look at tax rates today, tax rates are very low historically. And, what's happening in the government right now, huge deficits, a lot of debt being racked up. It's a reasonable assumption to say that tax rates may have to go up at some point in the future. And so I'd like to talk for just a moment about tax bracket maximization. What is it? How does it work? Why should you consider it? So if you're in a low tax bracket, maybe you've retired and you don't have that earned income anymore, so you're in a much lower tax bracket, or maybe the coronavirus struck your industry and you're unemployed and you're finding yourself in a lower tax bracket, a lower income year than normal. There could be some opportunities here. The whole idea with tax bracket maximization is to recognize income to fill up your tax bracket without going in up to the next tax rate. And often this is done with an IRA to Roth conversion. And basically the difference between those two, an IRA, traditional IRA, has pre-tax money. A Roth IRA has contributions that have already been taxed in the Roth IRA and they're growing tax-free. And so the whole idea is if you're in a low tax rate, low tax bracket, you convert some of your IRA over to your Roth. That way, you recognize a little extra income. You got to pay a little bit more today, but that money is then growing tax-free for the rest of your life. And if you have this bucket of tax-free money in a Roth IRA, that is going to give you some flexibility later on in life to continue funding your income at a low tax rate.
Yeah, I could see how that could be. That's huge. You think about now, we're in a period, and we have been in a period of extremely low income taxes, right? Well, guess what? The printing presses are working overtime, and we just talked about the trillions of dollars. Who knows? This might cost $8 trillion by the time this is all over. No one knows. That money comes from somewhere. It comes from you and I and everyone else listening, the tax base, right? We're paying for it. So, and you also have an election year. We're not going to get into politics, but there's many people that would say that we're going to have to increase taxes at some point here to get out of this hole. There's only two ways to do it, is to raise taxes or grow out of it, right? And maybe a combination of the two. So I think this is a phenomenal strategy, and if you haven't looked at this, you definitely should, because this strategy will make sense for a lot more people, I would argue, over the next year or so than maybe it has before. Every year we do this strategy, but I'm thinking that this year there's going to be more people potentially that this is applicable.
Yeah, Jack, we've talked about this a lot, and we know there are a lot of folks out there, especially retired folks, that are in a 12% tax bracket. Now, if you're married filing joint, the 12% tax bracket goes all the way up to taxable income of just over $80,000. And that's after deductions. So really it's, over $100,000 of income and, just over $100,000 of income. When you take in the standard deduction, still in the 12% tax bracket. If you're in a tax rate, 12%, that's historically very low. This is definitely a strategy to consider. And there's another option when it comes to tax bracket maximization, is to realize long-term capital gains. If you're in a 10 or 12% tax bracket, you can actually capture long-term capital gains at a 0% tax rate. And, there's some rules about how you do that and how much gain you can capture that will get that 0% tax treatment. But essentially, if you're in that one of those low tax rates, there's some amount of long-term capital gains that you could capture. And the way that works, basically, you can sell the investment, capture the gain, you could buy back that same investment, reset your cost basis, and not have to pay any tax on it. So that's two ways to be thinking about tax bracket maximization, either converting a portion of an IRA to Roth, or if you're in one of those two lowest tax brackets, capturing some long-term capital gains at a 0% tax rate. So this is one of the ways that we focus with our clients on that efficient retirement. How can we think ahead and look for opportunities to pay low rates of tax and set our clients up in a position that they can continue funding their ideal retirement in an efficient way.
Yeah, awesome strategy. Well, I wanted to conclude by sort of beating the dead horse here, but to extend the Godfather offer. I'm going to make everyone an offer they cannot refuse. You might say, well, what is that? The offer is, after you contact us, if we complete that analysis for you, investment analysis, show you how you can be more nimble, or you should be more nimble with your investment strategy, and we go through a sound financial plan, right? That complete financial plan, including tax bracket maximization. That's easy for you to say. And if you found no value in that efficient financial plan, no value in the nimble investment strategy, you don't owe us anything. Like I said before, we're going to part as friends, no hard feeling. But I can't really use the word guarantee, but I'm willing to bet that you will find value. And if I'm wrong about that, then you shouldn't hire us.
That sounds pretty good, Jack. I think that sounds like a great offer. I mean, you come in, meet with us, take us up on our free review. I don't see how you walk away from that meeting not getting something valuable out of it.
I agree, but that's not for us to determine. It is for you to determine. So again, visit our website, lakehillswm.com. Give us a call, 512-580-4740, or again, email us, jack@lakehillswm.com or jason@lakehillswm.com. And Jason, until next time, this has been just a pleasure speaking with our audience, and always fun talking to you about strategies to make everyone wealthier and happier.
Always a benefit, Jack, to talk over this stuff, and I look forward to talking again next week.
See you next time.
That's all for this episode of Profits to Wealth, but we have more resources available to you on our website. Head over to lakehillswm.com to request a free financial review or subscribe to receive weekly insights from Lake Hills Wealth Management. Until next time, we look forward to uncovering your path to financial freedom right here on Profits to Wealth. Investment advisory services offered through Lake Hills Wealth Management, a registered investment advisor. The information and views discussed on this show are not intended to be taken as individual advice. Additionally, past investment performance does not guarantee future results. Everyone's situation and goals are different. Please consult a professional about your specific situation before taking any action.